Good morning. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with EY Chief Economist Greg Dacko, as well as my colleague Candace Zacharias. Oh my gosh, Candace, do I say your last name right?
It's Zacharias, but that works fine.
Oh boy, I feel bad about that one. We are here to talk about Jobs Day. We've got the number coming out in about 5 minutes. It's a pretty consequential one. There's a lot of interesting debate going on around this, and the street's expectation is that we're going to add about 180,000 to non-farm payrolls in the United States of America through May. That would leave the unemployment rate unchanged at 3.9%. Perhaps the most interesting detail from a Fed standpoint might be what happens with average hourly earnings. You have a lot of policymakers that are keenly interested in knowing whether or not there is still wage pressure in the pipeline that might affect your inflation component here. But let me leave it right there and kick it over to Greg. Greg, what's your expectation going into this number?
Well, we're expecting a number slightly above the consensus, but not by much. One of the reasons is that we think there was a bit of a seasonality pull in the prior month, and that will essentially unroll. I think one of the key aspects that you just mentioned for the Fed and for Fed policy going forward is what's going to happen in terms of the breadth of job growth, as well as the direction of travel of wage growth. We've been in an environment where there's been a tremendous amount of focus on this first Fed rate cut. This past week, we had the ECB proceeding with the first rate cut. We had the Bank of Canada proceeding with the first rate cut. The Fed is likely to be on hold for a little while longer, but there's going to be a lot of attention in this report as to not just the headline print and whether we're seeing cooling labor market momentum, but some of the underlying dynamics. Are we seeing an environment where supply remains solid, where there is a rebalancing between labor supply and labor demand that is disinflationary? What's happening in terms of wage growth? What's the direction of travel of wage growth? Are we headed lower in terms of the month-over-month prints? And what does that signal in terms of inflation going forward? I think that's going to be really the key aspect. And let's not forget, even though the Fed has said it's not likely to cut rates in June at next week's meeting, there is still going to be another jobs report next month before the July FOMC meeting.
Okay. Yeah, and a key point to remember here from my standpoint, guys, I don't know if you'll agree with this, is there's just such a wide error band around not just the monthly non-farm payrolls numbers themselves, but like what constitutes a strong labor market in this non-farm payrolls data. What constitutes a too strong labor market in this data? And I got to say, from my standpoint, I would be remiss if I didn't admit I'm pretty confused, right? You've got these immigration dynamics going on. You've got sort of a very serious debate going on about what's more right between the monthly non-farm payroll survey data and sort of what we're seeing out of the QCEW census, and it's a head scratcher. Do you feel the same way, Greg?
I do. I think the ratio of signal to noise is quite low in the current environment, and that's why extreme data dependence, like we've seen from the Fed, is quite risky. As you mentioned, the QCEW data shows that essentially maybe payroll growth was overstated over the course of 23 by about 730,000 jobs in terms of the gains. That means that perhaps payroll growth was 60K lower per month. Which is not going to show a very weak labor market, but at least weaker than what we experienced in 23.
All right.
I think
I'll kick it over to you, Candace.
The concern for people is that maybe the Fed is missing something, right?
There we go.
There we go.
Candace, you want to give them the numbers?
Well, let's see. Change in non-farm payrolls. We were expecting 180,000. We've gotten 272,000. So, I mean, that is a huge upside surprise, I think, right there. And on the other hand, unemployment rate is at 4%, compared with the 3.9% that the market was expecting. If we had gotten another print under 4%, it would have been the 28th straight month of a sub 4% reading, but we don't have that. We have unemployment now at 4%. So a bit of a mixed signal there. And John, you mentioned, the importance of average hourly earnings. The month-on-month figure, the expectation was 0.3%. We have 0.4%. So again, a stronger reading. The year-on-year figure is also a stronger reading at 4.1%, compared with the 3.9% that the consensus forecast was looking for. Greg, do you want to unpack that a little bit?
Yeah.
Given that you said you were a little bit above market expectations, what do these numbers look like to you?
Yeah, I mean, overall, they don't look good from what we were just discussing in terms of the Fed being on a potential easing trajectory. I mean, they show relatively strong job growth. We were around 204,000 jobs expected for this month. This is a fairly robust print, even more robust than we were expecting. I would point to the fact that the private sector job gains were quite strong, around 230. And if you look at the broad nature of this report, it's more inflationary. So you have wage momentum that is quite strong. 0.4 on a month-to-month basis is not what you want to see in this type of environment. The acceleration in wage growth is a move in the wrong direction. That tends to be seen as leading into inflationary pressures down the road. And then one thing that I noticed here also in the print is that we have labor force participation that is declining. So it's still quite high from a broad perspective, but that downward movement in terms of labor force participation with the unemployment rate moving up is not necessarily the type of rebalancing that you'd want to see. So overall, it's not a great report from a Fed perspective, but it does show that there's still robustness in terms of the jobs market. We're still seeing solid job growth on a 3-month moving average basis, despite slight downward revisions to the 2 prior months. And that is, unfortunately, a situation where the Fed is likely to remain on hold for longer and not necessarily take much signal from the other indicators that point to some slowdown in job growth.
And I think, commensurate with what you said, we've seen US stock futures plummet. Obviously, markets are thinking the Fed is going to potentially be on hold longer here. And we've seen Treasury yields shoot up. So this is a market that was poised, I suspect, for a cooling and a report that sort of fed into the narrative that maybe the Fed is going to start to see the rebalancing that everyone's been hoping for. But instead, maybe we're not going to be there. John, what do you make of the numbers? Where is your focus?
Yeah, well, so I put the yield on the 10-year Treasury note up on the screen so everybody could look at the intraday chart, and it really underscored exactly what Greg was saying. I mean, off of the back of the number, you really saw quite a large, about a 10, 12 basis point move up in the 10-year Treasury 10-year Treasury yield, again, reflecting this idea that the Fed is going to have to be on hold for a little while. I still sort of believe that we're in a one number monetary policy, and that one number is inflation. Of course, we get the CPI next week, right before we get the Fed decision later in the month. We'll find out what that means for the PCE, which is the Fed's preferred gauge. The way I think about it is, the interaction between labor markets and inflation this cycle has been so complicated. And so if inflation starts to look great again, and we start to get the kinds of numbers that we were getting in the second half of 2024, I tend to believe that policymakers will eventually come around to saying, okay, it's time to start thinking about some surgical downward tweaking to the policy rate, irrespective of how strong or not the labor market is. I think, the labor market at this point in time, from my vantage point, is like sort of a free option for policymakers, insofar as a strong labor market probably wouldn't prevent them, I don't think, from starting to normalize policy rates, but a weak labor market, a meaningfully weaker labor market, I think, could bring forward some of those cuts. We're certainly not seeing the latter in today's data, though. That's for sure. And so I think, you're seeing some of the pricing of like that so-called free option come out of the 10-year yield right now as we speak.
John, I want to challenge you a little bit on that, just because of what we're seeing in the wage growth numbers. And Greg, I'd love to hear what you think on this.
Yep.
How important is wage growth for that inflation picture? There's been a lot of discussion over, what is the feed through and how much focus should the Fed be putting on those wage growth numbers?
Yeah, I think we have to be a little bit careful. My fear, and I've written about this extensively in a newsletter that I have on a monthly basis. But I fear that the extreme data dependence that we're seeing from Fed policymakers can lead to a policy mistake. I noted in our introductory remarks that we are in an environment where there tends to be a lot of noise relative to the signal in the underlying data. As John was pointing out, the data tends to be quite volatile from one month to the next, and there tend to be fairly large revisions. To your question about wage growth, it's important to remember that we used to say that a pace of wage growth around 3.5% was consistent with the 2% inflation target. Now, that's in a world where inflation is expected to be around 2% and underlying productivity growth is around 1.5%. When you have those two components, they add up to about 3.5%. In terms of wage growth. What we've seen over the last year and a half is essentially productivity growth that's much stronger. Now, there are questions as to whether this is sustainable, but productivity growth is closer to 3% than 1.5%. So if you were to say, okay, let's even shave that down a little bit and say productivity growth is closer to 2% underlying trend, and inflation is expected to be at 2%, that gives you wage growth at 4% that is consistent with 2%. That is important to keep in mind. We tend to look at things with our eyes from pre-pandemic. We need to be a little bit more focused on today's economic conditions. Wage growth around 4%, in my opinion, is not extremely worrisome. We're not seeing any signs of re-accelerating inflationary dynamics. And the underlying dynamics, when you look at pricing power, at markups, even at shelter disinflation, are still pointing towards disinflationary momentum going into the rest of the year.
You make a great point about post-pandemic eyes, right? We all need to put on a different pair of glasses in this world. John, did you want to take us through, the breadth of the market? Where were these job gains, and maybe particularly you can, give us a sense of what's happening in that white-collar professional group, because that's where we've seen some weakness in the past.
Yeah. So, I mean, I think the first thing that you observe when you look at the decomposition of May's payrolls gains is, strong breadth. Basically, every super sector is adding jobs. There really wasn't a sign of weakness anywhere. I mean, you see a little bit of red in mining and logging, but aside from that, 21,000 jobs added in construction, 27,000 added for trade transportation and utilities. This education and health services continues to run strong. Every month I sort of point out that super sector has its own things going on. You have sort of structural shortages of nurses in this country and so forth, but still adding a lot of jobs there. Leisure and hospitality, catches a bounce in May after some cooling. And to your question, you know, I was of the opinion that we were starting, you know, in the first few months of the year to see a kind of a two-track economy where some of those white-collar professions were seeing a weakening labor markets vis-a-vis other super sectors, but not the case in May. I don't think you would say. I mean, professional and business services adds 33,000. Financial activities, you know, which can be sensitive to, you know, like how many people are underwriting mortgages and things like that. Financial activities sees a bounce of 10,000. And so this just, it really feels broad based as much as you could ever really imagine. Are you with me on that, Greg? Or
Yeah, I mean, I'm looking through the details as well. I think generally speaking, you're right. I mean, we saw. I mean, if you look at the diffusion index, for instance, which is a measure of how many sectors across the economy are adding jobs, that bounced back up to 63.4%. That is the highest reading since December of last year. So there is a little bit more breadth to the job gains. You're right that it's still largely driven by healthcare, where there is a structural shortfall in terms of the labor supply. But if you look across categories, this is still a robust labor market. And I think that's where the nuance is difficult to understand and sometimes interpret. The question that we're trying to gauge and evaluate is whether the economy is experiencing any type of significant weakness. And I think the answer is no. As long as the labor market pillar remains quite strong, as long as we're continuing to add a steady number of jobs, around 240,000, which is the 3-month moving average, that is still a relatively healthy economy. I think one thing to keep in mind is how strong payroll growth is relative to the underlying supply, and what the actual break-even pace of the labor market is. What is the speed limit that is inflationary for the labor market? And that is still very much an open question. In the past, before the pandemic, we used to say that break-even job growth was around 100,000. Now we've seen estimates that put that break-even pace closer to 200,000. And some might even say it's even higher than that because of strong immigration inflows that are feeding into the working age population. So that is very important to understand. And that's another question mark in terms of having our eyes of the pre-pandemic versus new eyes when we look at the data. Is that pace of job growth around 240,000, 250,000 really strong relative to supply? Or is it more or less in line, in which case it's not inflationary, in which case it's not so much of a concern for the Fed, and the Fed can consider recalibrating monetary policy gradually and do so carefully, and not necessarily risk of a policy mistake by maintaining policy too restrictive.
Right. I want to ask you a little bit about the conflicting signals we have out there. So, for instance, you know, the household survey numbers that we also just got shows a big drop in employment. We've seen again some conflicting signals from the quarterly census of employment and wages that John mentioned earlier on. So there are some people out there who would suggest, look, we're seeing a strong labor market from the payrolls number, but there are signs that maybe there's something else going on under the hood. How would you respond to that? I don't know who wants to go first.
go ahead, Greg.
I'm happy to jump in there. I think you're right. I mean, the delta between the household survey employment and the payroll survey employment numbers have been growing over the course of the past few years. And I think there is an underlying question as to what is the best indicator, what is really telling us what the true underlying pace of economic activity is. I think one of the differences between the two has to do with what I just explained in terms of potential immigration flows being captured in different surveys in different ways, and supporting a pace of growth, an underlying pace of growth that is perhaps higher, a potential pace of growth for the labor market that is potentially higher. The other has to do with what we were talking about earlier. There are different ways to measure job growth, and the quarterly census of employment and wages, the QCEW, is another measure that is used to benchmark payroll gains on an ongoing basis. Now, in August, we'll get the mid-year review in terms of last year's payroll growth. And then in February, we'll get February next year, we'll get the prior year's revisions. These point for now to lower payroll growth than what we're seeing in terms of the payrolls report. That does not mean, again, that we are in a weak labor market or that we are seeing any signs of retrenchment. I think if you take all of the data together, what it points to is a robust labor market that is gradually normalizing. If you look at hours worked, for instance, as an indicator of capacity utilization, they've been essentially treading sideways for the better part of the last year. They were flat over the course of May. They're towards the lower end of that post-pandemic range, but they're still in line with where they were back in 2018, 2019. So we're not necessarily seeing any rapid decline in utilization of labor. We know that the focus right now from employers, and this is something that we hear again and again here at EY, is that CEOs are keenly focused on retaining talent, even if there are signs of a bit of a slowdown in labor demand, because they struggled so hard to hire the right type of talent, train that talent, and retain that talent over the prior 3 years where there was a tremendous amount of churn. Now there's much less churn, but businesses are being very cautious to maintain that talent that they trained and that they brought up to speed in terms of their processes.
Right. John and I have discussed a few times that if you have a job, this is a good labor market to be in because your employer doesn't want to let you go. If you don't have a job, it's getting to look tough out there. But John, why don't you tell me what you think about these divergences in the data, and if you agree with Greg that really there's nothing to be alarmed about?
Yeah, well, I mean, it's not helping anybody to say so, but it's times like this when you just really wish, the Federal Reserve and other policymakers just had better tools, better data with, narrower margins of error, so to speak, because it is so difficult, right? I mean, immigration is a key question here. I think that it's potentially a key reason why the QCW data diverges so much from the data that we get from the monthly payroll survey, and it's also a key question because we sort of know now that we underaccounted for immigration over the past couple of years, but what we don't know is what immigration is going to look like going forward, and it may indeed look very different. It's a politically charged issue. We just saw this executive order from the Biden White House, and we have no idea how this is going to shake out. When Brookings Institution came out with this influential paper some months ago, that famously came up with a much higher estimate for what the sort of neutral monthly payrolls gains consistent with a minimally inflationary environment would be, and they said it could be as high as 220 some odd thousand jobs, but the folks at Brookings do not know where the immigration trend is going. Anybody who presumes to know what is going to happen in this politically charged, demographically complicated arena is fooling themselves. So there's a ton of uncertainty around this, and Greg's key point earlier is so spot on that it's like, we have a data dependent central bank, the most important financial institution in the world. It's got all of our fates at their fingertips, and they say they're data dependent, but the data is not going to help us that much going forward. Certainly not, if we're microanalyzing month-to-month payroll surveys and saying, well, 10,000 here or there should completely change my policy perspective. 10,000, 20,000 jobs can get revised away in the blink of an eye, the way things are going. That's my take.
Yeah, absolutely. I mean, that's a point that another columnist of ours, Mohammed El-Arian, has made repeatedly, that it's really important for the Fed to not be looking at. We've got to remember this is historical data, right? It tells you about the past, and what we really want to know is what's going to happen in the future. I wish we all had a crystal ball. We don't. But you see the market responding so strongly to every little tick in inflation data, in employment data, because the Fed has told us, look at the data. And so that's definitely an issue that complicates things. I wonder if, Greg, we can take a minute more on this inflation question. It is politically charged. We don't know what's going to happen going forward, but we do know that there seems to be consensus that something needs to happen. Something needs to change. And given how important immigration has been to maintaining balance in the labor force, how do you see that playing out in the future if we start to see some of those numbers come down?
Well, I mean, I think it's undeniable that we've seen a very strong rebound in immigration. And the combination of that rebound in immigration and strong labor demand, and I'm talking over the past couple of years, has meant that you've had a better balance between labor demand and labor supply. And that's really, in the end, the holy grail. You want to have balance between labor supply and labor demand. Why? Because that's non-inflationary. And that in turn means that the Fed can recalibrate monetary policy and have a policy rate that is more adapt to an environment where inflation's close to the target, where the economy is rising or growing at its potential, and where the labor market is also at its potential. That is really what you want to achieve. Now, we've had some massive swings in terms of immigration. This all started before the pandemic with restrictions on immigration, and then very rapidly during the pandemic, significant restrictions on immigration. For the better part of essentially 2 years, you had extremely low immigration levels. And then those started to rebound. You initially had a rebound in terms of legal immigration and more or faster visa processing. And over the course of the past year and a half or so, you've actually regained some of these losses, these shortfalls of prior years in terms of immigration. That, as John was saying, has led some to estimate that the speed limit of the labor market is closer to 200,000 jobs on a monthly basis. That is important to keep in mind. Now, when you have this political uncertainty as to what's going to happen in terms of potential future flows of immigration, whether it's under the Biden administration or under a potential Trump administration, that uncertainty can lead to essentially some disruptions in terms of business decisions. So the answer is unclear as of yet, because we really have to see the flows. But if there is a sudden slowdown in the immigration flows, that would slow the break-even pace of job growth. That would mean that any job growth higher than a lower level would be more inflationary, and that could start to signal the risk of renewed inflationary pressures. I don't necessarily foresee that today. I think we're still seeing that the labor force participation rate, even though it fell back to 62.5, is still rather elevated. The prime age labor force participation rate is also still quite high. And again, I think that if you look at the broad picture of wage growth, you're not necessarily seeing any signs that this is extremely inflationary. I would come back to one theme that I've highlighted a few times in the past, which is that of the Fed and Fed policymakers needing to have much more of a forward-looking framework. You mentioned that this is historical data. That's the data that we have. The need to look at the breadth of inflation, at the underlying inflationary dynamics, at the underlying wage and employment dynamics is very important from a Fed policymaker standpoint. And the need to communicate the transmission of monetary policy into the economy and how effective it is of key essence. We've put way too much focus on when the first rate cut will occur and focused much less on the destination and the pace of travel over the next few years from a Fed perspective. This has been the case from the ECB, from the Bank of Canada. I think we need to really do that, because otherwise you're going to see these wild swings in terms of market pricing. I was just pricing or looking at the pricing for the first rate cut. We're now down below 50% for September onset of the easing cycle. So that was above 60% just before the payroll report. This is the type of rapid swings in market pricing that is reflective of the self-reflective environment where the Fed is looking at financial conditions and investors are trying to interpret what the Fed's going to do.
It's all very circular, isn't it? You mentioned the ECB and the Bank of Canada. Just a reminder to our listeners that both central banks initiated their interest rate cutting cycles this week. I want to ask you a little bit about policy divergence and what it means for the US economy and potentially also for those two other economies. How much divergence can we see before a strong dollar starts to hinder the US economy in some way?
Well, to some extent, we've already seen a strong dollar, and the strength of the dollar has been quite something to behold over the course of the last few years. I think we have to keep in mind that while we were in a rather synchronized tightening cycle from central banks around the world, especially advanced central banks, emerging market central banks were actually slightly ahead of the curve in tightening monetary policy earlier. But in terms of advanced central banks, we had a fairly synchronized tightening cycle with all central banks raising rates at a historically rapid pace. And then we had a bit of a holding pattern over the course of the past year or so. And now we're in this environment where we're much more likely to see a desynchronized easing cycle by central banks around the world, with each central bank taking its time, being very careful to avoid any resurgence in inflation. But there is likely to be, over the coming months, more divergence in terms of interest rates, key policy interest rates. If you think about the underlying dynamics, economic dynamics in Canada and Europe, they are notably softer than that of the US. The Canadian economy has been flirting with a recession. The Eurozone has essentially been stagnating for the better part of the last 18 months. So the underlying economic dynamics are softer in the US, which has been growing at that 2.5% to 3% pace last year and still through this year. So that is one element to keep in mind when it comes to this divergence of monetary policy. The other, which is, I think, key, is that you're going to have central banks that have more of a forward-looking perspective and others that have more of a backward-looking perspective, which means that the Fed can be on hold for a longer period of time, and the ECB and the Bank of Canada, which have shown more of that desire to look at what's ahead of the curve, may have more of that easing stance, especially if their underlying economies are somewhat weaker, and that drives slower inflation. So that will likely continue to put upward pressure on the US dollar, all things equal, the growth differentials being favorable to the US and monetary policy being more restrictive and tighter in the US than in other economies is likely to pressure the dollar up to the upside over the course of the next few months.
Right. John, does the dollar strength concern you, or are you a little bit sort of in the camp that it's a sign of strength? This is a strong economy, and that's what the US dollar is showing you.
Yeah, well, I mean, I think we talk a lot about the American exceptionalism story here at Bloomberg Opinion, but this is primarily a story of interest rate differentials, right? It's kind of that black and white, and I think this sort of dollar strength or other currency weakness has in the past been a problem for like emerging market economies, but it's all a question of divergence, right? So Greg was talking about how the Fed may be a little bit later to make the turn, but when we talk about later, does that later really mean 3 months, like a September or a December cut, or does the Fed's framework lead them to such a divergence that it lasts for a year or longer? I think in that circumstance, I think there are real possibilities that dollar strength could lead to problems elsewhere in the world, and problems elsewhere in the world in our global economy eventually come back to our shores in some way, shape, or form. But it's really all a question of timing. And this morning, before I saw today's a strong payrolls number, I would have thought, yeah, the Fed's on hold, but maybe just till September. That conversation may be changing a little bit. I'd be I'll hold my tongue until we see what CPI looks like, what the Fed's summary of economic projections look like next week. But are we talking about 3 months divergence? That's nothing in the grand scheme of things. Are we talking about 12 to 24 months of divergence? That could really become a story.
I know there are some house hunters out there who will not like to hear what you just said about 12 to 24 months, given what Fed policy means for mortgage rates. But Greg, what are you thinking around when we start to see the Fed ease policy? Is September still on the table? Is it back to December now? Is it next year?
We don't know is the honest answer. I'll calibrate my response in saying that I think the Fed should consider the onset of easing monetary policy. I think there's been way too much focus, too much attention to the first rate cut. It's a marginal rate cut if it happens of 25 basis points. It doesn't change the game, but it shows that the Fed and Fed policymakers have that forward-looking perspective as to the underlying dynamics of the economy, both inflationary and economic, in terms of the labor market. And it shows that the Fed is gradually repositioning itself. So we've been saying that the Fed should cut in July. I think the July rate cut now is less likely given what we've seen in terms of the labor market report. But I still believe that we have to focus on underlying inflationary dynamics. What is inflation doing under the surface? What are the indicators in terms of breadth of inflation across different segments? What is the inflation expectations telling you in terms of the direction of travel? Are businesses pricing up? Are consumers more sensitive to prices? Is rent disinflation in the pipeline? Is inflation supported by insurance, which may not necessarily be influenced by Fed policymaking? All of those factors need to be considered, and there does not need to be a laser focus on the 2% target. That is going to lead to policy errors. So I would argue for a much broader monetary policy framework with more communication as to monetary policy transmission. And that, in my opinion, would be the optimal way for the Fed to proceed gradually, carefully, and be prudent in terms of how it conducts monetary policy.
All right. Well, I think we should leave it right there with those very helpful final words, Greg. For everybody who's just tuning in, we're coming off of some stronger than expected non-farm payrolls numbers, and on the back of that, we have your U.S. Treasury 10-year note, the yield on that up to 4.42%. The market's snap reaction, for what it's worth, is that this is, if anything, delaying, or I should say, at a minimum, delaying the odds of rate cuts in the immediate term. And so we shall now turn our focus to CPI and the Fed next week and do it all over again. Thank you very much, Greg. And thank you, Candace.
Thank you, John. Thank you, Candace.